To talk about all of this, let's go to our featured guest of the morning. He's Jeff Hall, Senior Financial Advisor at Manulife Wealth. Jeff, first of all, thanks a lot for being here.
Always good to see you.
6 consecutive months of price declines in the Toronto housing market. Expected with higher borrowing costs?
Oh, no question. Absolutely. This has really been a choke point for a lot of Canadians that are suffering right now. You know, they enjoyed that COVID low rate of 1.5% to 2% for some mortgages, even some home line of credits, as an example. Year and a half later, they're at 7.5%. It's really squeezing a lot of Canadians out there, so it's very tough. And that's obviously having a big influence on real estate.
Markets, of course, are dynamic. There's a summary of what TREB has reported. TREB is the Toronto Regional Real Estate Board. These are numbers from January. Prices are down for the 6th consecutive month. The benchmark price, there are many prices that TREB releases in its report, but the benchmark price of a Toronto home in the Greater Toronto area down 1.2% to $1.08 million, and sales, as we told you, rose by 37%. Markets are always dynamic, and as we noted earlier, the 5-year bond yield is determinative when it comes to fixed rate mortgages. Variable rate mortgages are much more influenced by the Bank of Canada rate, and Tiff Macklin will be speaking later today. And of course, there are broad expectations among Canadians that that rate will begin moving down at least in the second half of this year. What's your take on what Macklin may say today, and what do you expect from the Bank of Canada?
I don't think he's going to telegraph too much. I think a lot of people were hopeful or aspirational that might happen in the spring. That's way too early. The Bank of Canada joined the party way too late in raising rates, and they don't want to make the same mistake the other way and start cutting too soon and end up back in a problematic scenario. So I think the correct scenario would be they will start to cut rates sometime in the second half, and there may be 2-3 cuts as an example. We expect the same thing actually south of the border as well around that timing, but most of the benefit would be received in the latter half of the year, not the first half.
The bank never says that it's worried about the Canadian dollar, and specifically doesn't say we adjust rates with a view of where the Canadian dollar is. But what do you think the bank's thinking is on the dollar? If the bank cuts faster than the Fed does, the dollar's likely to come under pressure. If the Fed cuts faster, the Canadian dollar may rally.
Yeah, it's always an interesting dance here in Canada because we don't want our dollar too high because then a lot of Americans won't buy from Canada, as an example. So there's always that equilibrium that they're trying to find, but it's probably somewhere close to where it is now. It's not going to be a massive movement, but there will be a dance between both the Bank of Canada and the Fed lowering those rates. It's going to be interesting to see who pulls the trigger first.
Do you have advice to clients who may be wondering about getting ready to take on a mortgage or a mortgage for their children, for instance? Should they wait, or is timing a mug's game when it comes to a real estate market like this one?
Well, taking on mortgages for kids is a whole horror show unto itself. But I would suggest people just be careful and be ready to pounce when rates do get lower again. A lot of people miss the boat entirely and have been suffering, holding on by their fingernails from, again, those rates going from 2 to 7 has really squeezed a lot of Canadians. So they should be ready to take advantage of lower rates when they do come, but they're not going back to where they were in the COVID heaven of rates under 2%. That's a long ago fantasy.